Welcome back to Deep Dive number 93. I'm your host. And the third week of July 2026 has proven exactly why the digital asset markets are not for the faint of heart.
Yeah, no kidding. It's been totally wild.
Right. So today our mission is to unpack this massive divergence we're seeing in the sources. Like, why is the smart money basically building a fortress while the retail side just runs for the exits?
Well, it comes down to a collision of two major macro forces in mid-July. First, we saw geopolitical tensions in the Middle East flare up, driving this sharp spike in oil prices.
Which, immediately woke up those dormant global inflation fears across financial desks.
Exactly. But the real catalyst, the thing that added fuel to the fire, was U.S. regulators completely missing the critical July 18th Genius Act stablecoin deadline.
Leaving the market in this huge cloud of regulatory uncertainty.
Yeah.
And the immediate result of that dual threat was just carnage. A massive $158 million liquidation wave within 24 hours.
Yeah, it was a really aggressive flush out. Ethereum actually led the wipeout with over $37.2 million liquidated, and Bitcoin followed right behind at roughly $26.78 million.
Wow, that is heavy.
It is. But notice the mechanics here. It wasn't purely panic selling. It was a mechanical reset, liquidating both over-leveraged longs and shorts to just clear out the market's speculative froth.
Which explains why retail sentiment completely cratered. The fear and greed index plummeted down to 25 points, hitting extreme fear.
Yeah, total panic.
It's like retail investors were just passengers on a ship without a rudder during the storm. But I have to ask, is this just standard volatility? Or are we looking at a fundamental fracture in market trust here?
See, that's the fascinating part. While retail was that rudderless ship, institutions were acting like battleships dropping anchor. The market structure has just completely changed.
Because we did see a brutal single-day ETF outflow at first,
Yeah.
like $424.7 million.
Right. But normally that kind of institutional selling sparks a prolonged, devastating bleed. Instead, that outflow was rapidly reversed by a $132.3 million net inflow.
Spearheaded heavily by BlackRock stepping in to buy the dip.
Exactly. And that institutional shock absorption stabilized Bitcoin firmly above $64,000, locking it into a 56.4% market dominance.
So they're pricing in major structural floors rather than trading the panic. And speaking of floors, we have to talk about the political side. Over on Truth Social, Donald Trump just urged the Senate to swiftly pass the Clarity Act.
Right, framing digital asset development as a strategic necessity to outpace China.
And just to be completely clear for you listening, we're simply reporting the stance from the source material here. We are not taking any political sides. But it is a major political floor being established.
Absolutely. And you have to combine that political signaling with the incoming structural realities. The FTX bankruptcy estate just announced the infrastructure to pay out $900 million to creditors this quarter.
Oh, wow. So that's a massive demand floor for Q3. Wall Street analysts know that a significant chunk of that fiat cash is going to be reinvested right back into liquid crypto assets.
Right. Smart money is just front-running that impending liquidity injection.
Okay, that makes sense for Bitcoin.
Yeah.
But let's look at the altcoin trenches, because the macro divide there is even wilder. On one hand, you have Zcash staging this massive privacy narrative breakout, surging to $558.73 on $705 million in volume.
It's a massive move.
But then on the other hand, the meme coin bonk is in an ongoing 5.78% collapse from a DAO exploit where an extra 800 billion tokens were dumped. Why does a legacy privacy coin thrive right now while a meme coin bleeds out in this regulatory vacuum?
Well, it's the ultimate test of utility versus excess. When legislation like the Genius Act stalls, fear of future government overreach naturally spikes.
Right.
And that drives fundamental demand for decentralized privacy layers like Zcash. But meme coins, they rely entirely on excess market liquidity and hype.
So when a macro storm hits and governance flaws are exposed,
the hype just evaporates instantly. The sell pressure becomes insurmountable.
The hype burns off, and only the utility remains. So the core takeaway for you listening today, you really have to look past the short-term retail anxiety.
Yeah, when macro shocks hit the headlines and the fear and greed index drops so low, it's easy to lose perspective.
Exactly. While the speculative froth was aggressively liquidated this week, the structural foundation quietly absorbed the pressure. Between BlackRock buying the dip and the looming FTX payouts, the demand floor is incredibly resilient.
The foundation held up perfectly.
Which leaves a really provocative thought for you to chew on. With smart money now so deeply entrenched at these levels, what happens to retail influence once the Genius Act regulatory vacuum is finally filled?
It's going to be fascinating to watch play out.
Keep a close eye on it. All the data points on the ETF flows, the Clarity Act, and the Zcash breakout are linked right below in our show notes. Stay disciplined, protect your private keys, leave emotion out of your strategy, and we'll see you in Deep Dive number 94.